So in share price terms, Jupiter US smaller companies, BlackRock North American did particularly well. This was helped by closing discount. Infrastructure debt and private equity funds also did particularly well, as did Linsell Train, helped by the premium doubling. In NAV terms, it was really the private equity exposed, those trusts buying private assets that did the best. This is perhaps unsurprising because they, of course, their assets don't revalue along with public markets, so they held up better. But of the conventional asset classes, particularly worth a mention are two Baillie Gifford trusts, Baillie Gifford Shin Nippon and Edinburgh Worldwide, both of which returned over 10%, despite the fact that the market sold off quite violently in the second half and their style was inordinately hit. So there was very good returns for those two trusts. So we think global equity markets will be driven largely by what happens in the US. Now, hopefully that remains simply the rate cycle, the steady increase in rates that we expect to continue. And the current state of the US market, we would say, is pretty much end cycle. So we don't expect big returns from the markets, probably sideways markets overall. And probably this means that the more speculative growthy areas will sell off. So Bitcoin is one example, but also the more faster growing technology companies, they're probably going to see some weakness next year, we would expect. So this is probably a time to be looking to diversify your portfolios, look for areas of value, maybe even reduce overall equity exposure. So I can't say that there are any areas where investment trusts are bad or a disadvantage. So I think investors should always consider investment trusts. I think they particularly excel in areas of illiquidity. So that could be certain asset classes which are by their nature illiquid. A classic example would be property, which we think is much better suited to closed-ended structure. And that's because open-ended managers need to manage inflows and outflows, and therefore they can get stuck trying to sell buildings in order to meet outflows at times of market stress, which happened in the June 2016 referendum and also in 2008. Well, the alternative is they keep large amounts of cash on the balance sheet, which means that you reduce your exposure to the asset class anyway. So areas such as property, much better suited to investment trusts. But this advantage also comes through in the more mainstream asset classes, equity exposed trusts. In the closed-ended structure, investment trust managers can keep a much higher exposure to smaller mid-caps and the more illiquid areas of those markets too, and they can keep much lower cash balances. You can see, for example, in the numbers that the average closed-ended fund has an exposure of almost 60% to smaller mid-caps, UK or companies, investment trusts. That compares to just 40% for the open-ended sector. In terms of cash, the cash weighting is around half of what it is in the open-ended funds. So for long-term investors, you can get much greater exposure to the faster-growing illiquid areas of the market, and over the fullness of time, over a full market cycle, you should get better returns. I think there are two main advantages that investment trusts have when it comes to income. The first is their ability to smooth dividends. So investment trusts don't need to pay out all of the income they receive from their portfolio every year. They can hold back 15% for future years. This means that the boards and therefore the investors can have much greater clarity on the income they're going to receive in coming years. For investors who are living off their income or meeting liabilities from their income, this is a huge benefit. So that's the first advantage. The second is that investment trusts, because they can invest in more illiquid asset classes, can offer exposure to higher yielding assets that you can't really get in the closed-ended, in the open-ended space. Good example would be in the renewables space, where the renewables infrastructure group offers a yield of around 6% from diversified renewable energy assets. Greencoat UK Wind yields just over 5% from wind power. You can't get exposure to these areas through open-ended structures, and they offer very attractive yields. We did a piece of research back in October looking at the most attractive trusts for income. And what we tried to do was to look at a broad range of metrics. So not just the yield and not just the consistency of paying a dividend, but the current coverage, the income on the underlying portfolio, capital growth potential, a number of things which are important to investors. We came up with a short list at the end, but maybe I could highlight just two. The first would be Schroeder Oriental Income. This offers a yield of around 4%, 4.2%, which is what you would get from the average UK equity income trust. But it does so by investing in a market with much greater growth potential, Asia. The manager, Matthew Dobbs, is a bit of a smaller mid-cap specialist with a great deal of experience. So the portfolio tends to be a bit more overweight to that area of the market. And it's had outstanding total returns as well as from an income generating perspective, and it offers a really good diversification to the average UK investor. Second example would be Chelverton UK Dividend Trust. This is an interesting one because it's too small for most institutional investors to really be able to use it. It's only around 50 million market cap. But for the private investor, it's an interesting thing to consider. The managers have a very good track record in the open and closed-ended space. It's focused on small and mid-caps, which is their area of speciality, and it yields just under 5% at the moment. So it's a very attractive way to potentially diversify your portfolio.